Market capitalization is the total dollar value of a company's outstanding shares of stock. It's often referred to as market cap for short. Market cap is calculated using a simple formula. Multiply the total number of outstanding shares by the current share price. Let's see an example. If a company has 10 million outstanding shares and each share is trading at $50, we multiply these values together. This gives us a market capitalization of $500 million. This represents the total market value of the company as determined by the stock market. Market capitalization is significant because it represents the public's valuation of a company. It serves as a key indicator of a company's size and is widely used by investors to compare companies within the same industry. Market cap helps investors distinguish between companies of different sizes. As we'll see in later sections, companies are often classified based on their market capitalization. The formula for calculating market capitalization is straightforward. Market cap equals the current share price multiplied by the total number of outstanding shares. Let's look at an example with a fictitious company, TechCorp. With a current share price of $85.50 and 10 million outstanding shares, TechCorp's market cap would be $855 million. Outstanding shares include all shares currently held by shareholders. These include institutional investors, like mutual funds and pension funds, public shareholders who buy and sell on exchanges, and restricted shares owned by the company's officers and insiders. It's important to note that market cap is not a static measurement. It fluctuates throughout trading days as stock prices change. As the share price changes throughout the day, the market cap changes proportionally. Let's see this in action with our example company. To summarize, market capitalization is calculated using a simple formula: share price multiplied by outstanding shares. It includes all types of shareholders, and it's a dynamic measurement that changes with stock price fluctuations. Market capitalization is used to classify companies into different size categories. Mega cap companies are the largest, with market capitalizations exceeding $200 billion. These include giants like Apple, Microsoft, and Saudi Aramco. Large cap companies range from $10 to $200 billion in market value. This category includes established companies like Starbucks and Goldman Sachs. Mid-cap companies fall between $2 and $10 billion. These include growing businesses like Dunkin' Brands and Crocs, offering a balance of growth and stability. Small-cap companies are valued between $300 million and $2 billion. These smaller businesses, like Bed Bath & Beyond and Carvana, often offer higher growth potential, but with increased volatility. Microcap companies have market caps below $300 million. These are often startup companies or penny stocks with the highest risk, but also potential for substantial returns. When comparing these classifications side by side, we can see the dramatic difference in size from megacap to microcap companies. These classifications help investors understand the relative size and risk-reward profiles of different companies. Generally, as market cap decreases, both risk and potential reward increase. Market capitalization and enterprise value are two different ways to measure a company's value. Market cap represents only the equity value of a company, calculated by multiplying stock price by shares outstanding. Enterprise value provides a more comprehensive picture by also accounting for debt, cash, and other factors. The formula for enterprise value is straightforward. Enterprise value equals market cap plus total debt minus cash and cash equivalents. Let's look at an example. A company with a $1 billion market cap also has $200 million in debt and $300 million in cash. Its enterprise value would be $1 billion plus $200 million minus $300 million, resulting in an enterprise value of $900 million. Enterprise value is considered by many analysts to be a more accurate representation of a company's total value, especially for acquisition purposes. When acquiring a company, the buyer not only pays for the equity, but also assumes the debt and acquires the cash. This is why enterprise value is often considered the true acquisition cost, and a more comprehensive measure of a company's value than market capitalization alone. Market capitalization is a crucial metric that helps investors make informed decisions. Market cap helps investors diversify their portfolios by balancing holdings across companies of different sizes. Market capitalization serves as a risk indicator. Larger companies typically offer more stability, while smaller companies may provide higher growth potential but with increased volatility. Market capitalization is widely used in index construction. Many major indices are weighted by market cap, meaning larger companies have a greater influence on index performance. To summarize, market capitalization helps investors diversify portfolios across company sizes, assess risk profiles, and understand how market cap weighting affects index performance. Despite its widespread use, market capitalization has several key limitations investors should consider. Market capitalization doesn't account for a company's debt levels or cash reserves. Two companies can have identical market caps but vastly different financial health. Company A has more cash than debt, while Company B is heavily leveraged. Enterprise value accounts for these differences, but market cap alone doesn't reveal the true financial picture. Market cap can be distorted by stock buybacks, which reduce the number of outstanding shares. When a company buys back its own shares, the reduced share count often leads to a higher stock price. This can artificially inflate the market cap relative to the company's actual operations. This can create the illusion of increased company value, even when there's no improvement in business operations. Market sentiment can significantly impact stock prices and, consequently, market cap. A company's fundamental value may remain stable, but market prices can fluctuate dramatically due to investor sentiment, news, or market trends. This can sometimes disconnect market cap from a company's fundamental value, leading to overvaluation or undervaluation. Market cap doesn't reflect a company's growth prospects or competitive position within its industry. Two companies can have the same market cap, but vastly different future prospects. One might be a slow-growth legacy business, while another is an innovative company with strong growth potential. Investors need to look beyond market cap to assess a company's true potential and competitive advantages in its industry. To summarize, market capitalization has four key limitations. It ignores debt and cash positions, can be distorted by stock buybacks, is influenced by market sentiment, and doesn't reflect a company's growth prospects. Market capitalization influences various investment strategies, each targeting different segments of the market. Investors choose different market cap segments based on their investment goals, risk tolerance, and market outlook. Growth investors typically target small to mid-cap companies with high growth potential. These investors focus on companies expanding their revenue and earnings at above-average rates. Value investors look for undervalued companies across all market cap ranges. They focus on strong fundamentals and companies trading below their intrinsic value. Index investors gain exposure to companies based on their market cap weightings in various indices. This passive approach naturally allocates more capital toward larger companies while still providing diversified exposure. Many successful strategies combine market cap considerations with other factors. For example, small cap value investing targets smaller companies with value characteristics, potentially offering higher returns with increased risk. Understanding these approaches helps investors align their portfolio with their financial goals and risk tolerance. Conservative investors may prefer large-cap stocks, while those seeking higher returns might allocate more to smaller companies. Market capitalizations can change dramatically over time due to various factors. Economic cycles, technological disruptions, regulatory changes, and shifting consumer preferences all impact company valuations. For instance, the technology sector has seen substantial market cap growth over the past decade, while once dominant sectors like energy have experienced relative declines. Market-wide events like the 2008 financial crisis or the 2020 pandemic can also cause significant shifts in market capitalizations across entire industries or regions. Market capitalization serves as a fundamental tool when analyzing companies for investment. Investors rarely rely on market cap alone. Instead, they combine it with other financial metrics like price to earnings and price to sales ratios to gain a more complete picture. A key analytical technique is comparing a company's metrics to its industry peers with similar market capitalizations. This comparison helps identify whether a company is potentially overvalued or undervalued relative to its peers. Companies with similar market caps but significantly different valuation ratios may present investment opportunities. Comparing a company's market cap to its industry average helps investors understand its relative positioning in the market. Companies significantly above or below the industry average may warrant further investigation, as this deviation might indicate unique growth opportunities or potential risks. Tracking a company's market cap over time provides valuable insights into its growth trajectory and how the market perceives its developments. Significant events like product launches, market downturns, strategic acquisitions, and earnings growth can dramatically impact a company's market capitalization. Analyzing these changes helps investors understand a company's resilience, growth potential, and how effectively management navigates challenges.